Advisory services offered through VestGen Advisors, LLC, an SEC-registered investment advisor. Securities offered through Private Client Services, LLC, member FINRA and SIPC. Private Client Services and VestGen Advisors, LLC are unaffiliated entities. Any information discussed does not constitute investment advice. VestGen Advisors and Private Client Services do not offer tax or legal advice. People of Chicago, welcome to In the Know Radio with Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. You want help from someone you can trust, someone who knows what it takes to get retired and stay retired. Today, Craig's going to teach you what you need to know. So get ready to learn something that could change your life. Get connected to the show by calling 833-964-PLAN or go to getretiredstayretired.com. And now, here's Craig Bolanos.
Hey, good morning and a very happy Sunday to you. We're here to give you the sincere and actionable ideas that you need to improve the lives of yourself and your loved ones financially. Markets move fast. Tax laws change. Retiree healthcare is difficult. Navigating the silent killer of retirement, that is inflation. It's here again. It's slowly walking everyone down. What are the strategies you can use to cure all of those items? That's what we're here to drive. I want you to connect with us online at getretiredstayretired.com. Getretiredstayretired.com. Now today, listen, we got to come back and discuss something that sounds simple, but might actually be one of the most overlooked concepts in investing. I mean, most investors are focused on market returns, account values, benchmarks, but I think there's a little bit more. So David, let's do a little bit of Q&A and tell people what it means to be investing for a real return.
Yeah, I think it's a very important question people should be thinking about. And to your point, it goes a little bit farther than just, what was the return? It's how far does my dollar actually go? And, a lot of times in the conference room, we're having conversations with people about cash flowing and, purchasing new cars or going on trips. And I made the comment to someone the other day, I said, it's not just inflation, it's inflation also compounded by something like a weaker dollar if you're going on a Viking River cruise. So let's start with that, Craig, which is, are investors asking themselves the wrong question, and what should they be asking themselves instead?
Yeah, I think what's happening is investors and their old school advisors are simply asking and answering questions like, how much did I make? But the better question truly is, what will my money actually be able to buy in the future? Because ultimately, no one's retiring on a percentage. You're retiring on purchasing power. And the real purpose of investing isn't accumulating a larger account balance. I mean, it's a part of it by de facto, but the real purpose is maintaining a lifestyle, funding your retirement, paying for your health care, helping your family members, creating financial security. And that's where that concept of real return just becomes so important.
So let's define that then. How would you define real return?
Well, here, David, a nominal return, nominal is what people see on their statements, they see in their online portal. I mean, if your portfolio earned 10%, that's your nominal return. But a real return is what remains after accounting for inflation and the rising cost of living. In other words, it's the growth in your actual purchasing power. Because, David, if your investments grow 10%, but your expenses, honestly, are growing at a rate of 5%, you're not really ahead by 10%. I mean, the practical value of someone's wealth is growing much more slowly. And over decades, that difference becomes enormous. So, David, nominal return is what you see on the statements and online. Real return is what you have after accounting for inflation and the rising cost of living, including currency devaluation.
Yeah, so what you're really saying is investors can make money, but perhaps they're still losing a little bit of ground every year.
Absolutely. That's exactly what's happening. I mean, I think it's one of the biggest misconceptions in investing that no one's talking about. Again, everyone's looking at their statements showing gains and assuming they're getting wealthier, but wealth isn't measured in dollars alone. It's measured by what those dollars can buy. Think about healthcare, housing, travel, college tuition, especially travel abroad now, courtesy of the de-dollarization. I mean, so many of those costs are just rising over time. And if your investments aren't keeping pace with real world costs that you're going to face later, your purchasing power is actually shrinking despite those positive returns.
So I mean, I feel the passion, on this, right? And like, this is something that you've been talking about internally for quite a while. Why do you think that this doesn't necessarily get discussed in the media very often, or other brokers and advisors aren't really talking about it with folks?
Well, first of all, the media is always written to discern information in something that's easy. I think other advisors, they take the easy path too. So, David, I think it's just this. Nominal returns are easy to discuss. Nominal returns are easy to compare. Nominal returns are what's reported in headlines, financial, radio. The reality, though, is when you're investing for a retirement, and that's what we're focused on, go to our website, getretired.stayretired.com. You're focused on something that's going to last 20 to 30 years. That's 2 to 3 decades. And purchasing power becomes far more important measured over that span than what happened year to date or in last year's nominal returns.
Yeah, I mean, people talk all the time about bigger benchmarks. You even hear about them on the 10 o'clock news. I mean, maybe that's a good way to score things, but what's the missing component? Why do you need to measure that, I guess, in a different way?
Well, no. Benchmarking has value in investing. It absolutely does. But remember, David, there's people listening to us right now, and they're starting to think what I already know. A client doesn't spend a benchmark. A client spends money. Say someone beats an index by 1 or 2%, great. But if inflation, taxes, all those things are eroding the purchasing power, then the benchmark comparisons become less meaningful. And at VestGen Wealth Partners, again, the better question is the portfolio helping the client, you, our client, achieve real world financial goals? I think that's a much more practical measurement of success for a multifamily office that helps people get retired and stay retired.
So let's talk about implementation then. How does this change the way that you actually construct the portfolio versus maybe what you would see from like a big box investment advisor?
Yeah, I think traditional portfolio construction is exactly that. It's traditional. It's focusing primarily on stocks and bonds. And again, real return investing starts with a different question. What are the future liabilities and spending needs of the client? And what forces could affect those future goals, those spending needs? Inflation, currency fluctuation, interest rate cycle, global economic conditions. And then we build portfolios with those specific risks in mind, not simply chasing nominal returns, preserving and growing purchasing power over time, which, David, means the bottom line is it's going to take more than just stocks and bonds in an account to get this done.
So you mentioned currency fluctuations. I think everybody understands inflation, but what have they not been paying attention to, or maybe what are people missing about currencies? Because if I'm right, we've been in an environment where we had a very strong dollar. It wasn't up until recently where that dollar started to hit the headlines in 2025, where people started to get maybe a little nervous.
Well, yeah, I mean, listen, the spring of 25 was a great example of this because we all know what we did in the spring of 2025. We started negotiating for fair trade, free trade, but fair trade. Okay, makes sense. But so many of the goods and services that we're buying, I'm an American, David, you're an American, our listeners are American, they're influenced by global supply chains. Again, it's assembled in America. Stuff isn't getting made in America. And what that means is when currencies move, prices are going to move. purchasing power is going to change. And you got to realize that those purchasing power changes around the globe are going to create domestic effects for everyone who's trying to get retired and stay retired. So it really is about currency.
So let's talk de-dollarization really quickly, because when we start talking about a weakening dollar, then some people want to take it to the extreme and say this is going to be a massive cycle issue. What should people be thinking about in terms of de-dollarization? Is that a big worry from your standpoint, or is that just a headline risk?
I think investors should be informed about it, not alarmed over it, right? I mean, the dollar is going to remain the world's reserve currency. America is awesome. America is exceptional. That's not changing. And certainly if it was ever threatened, it's not changing overnight. But we've seen the central banks, the institutions around the globe, diversifying portions of their reserves into other assets now for 13 consecutive months that are not U.S. treasuries. So the key takeaway here is follow the money. And that's why it's got to get addressed.
So very quickly then, in terms of the approach that we're using with families throughout the country, what is that approach if you had to refine it to just a couple of talking points?
It simply starts with this, David. At VestGen Wealth Partners, the philosophy begins with defined outcomes. And that's going to mean an implementation that looks beyond traditional portfolio construction. You got to consider a broadening opportunity set that includes real assets, larger amounts of tangible assets, acronyms you and I have talked about so many times, like HELP and HALO, and these other investments that can zig when other things zag. I think it's really about diversification with a purpose. So I want everybody to go out to our website, getretiredstayretired.com. That's getretiredstayretired.com, and download for free today from our website our real return investing publication. That's getretiredstayretired.com. Download our real return investing publication.
You want more in the Know Radio? You want more in the Know Radio? You can't handle more in the Know Radio. Okay, yeah, you can. And it's on AM 560. The Answer. Welcome back. Here's more with Craig.
All right, so if you want to get retired and stay retired, I've got an opportunity. We've got upcoming webinars and some in-person events that you can attend. Connect with us online at getretiredstayretired.com or a simple phone call, 833-964-PLAN. That's 833-964-PLAN. David, I'm so happy that we got to talk again about that concept of moving past nominal returns to really focus on what matters, which is positive defined outcomes. Besides that concept of real return, what is resonating as you're working as a practitioner with clients across the country at VestGen Wealth Partners today?
Yeah, I mean, ripped out of the conference room this week, I think a lot of clients are content, right? They're happy with the way things have been progressing, at least for the market and the economy. And I think when we have some of these slower bouts where there aren't massive changes that are happening with investments, then we spend a lot of time focusing on things that we can control. And I've got 3 of them written down here that I wrote down during the break, Craig. And number 1 is refilling that cash flow bucket. It sounds so simple, but I think this is one of the best ways for people to ensure that they have clear line of sight with their cash flow. Because when we start talking about risk in portfolios, oftentimes people might define risk as how much money do I have in the stock market? And then if they say something like, well, how much should I have? Then you're just making a call on the market. But if we have a plan that says we're taking a certain amount of money out, we can start to reverse engineer how much we might want to have in our reserves. So I think a big talking point for families in 2026 is, with the markets hitting all-time highs, wouldn't it make sense to take some profits off the table and build your reserves? Let your cash flow reserve bucket help define how you rebalance your portfolio.
No, David, I think that makes a tremendous amount of sense. I mean, after all, everybody regrets what they didn't do much more so than the things that they did. And people know that there's still some fragility that's out there, fragility in the jobs market, fragility in valuations. A lot of that's been exposed with corrections in software stocks, the recent decline in the NASDAQ, all of the concerns and consternations that's occurred because of the oil shock that led to the inflation spike. But David, give us some ground rules. And we think about those three pillars of retirement income, right? Let's talk about those. Talk about how cash flow reserves work and talk about how we're rebalancing, not on a calendar, but why we're rebalancing dynamically, because that's the level of attention that individual investors truly deserve.
Yeah, I think as we look at the markets, one of the terms I like to use, I say resilient fundamentals, but perhaps rising fragility in the market. So the underlying data looks okay, but we understand it's a fragile time. So when we're talking about the cash flow bucket specifically, most retirees are on a monthly distribution plan. So we can reverse engineer how much money we're going to be withdrawing on an annual basis. And I would say as a general rule of thumb, I think that a lot of folks are going to want at least 12 to 18 months of reserves just in case things roll over. You have clear line of sight as to where that money is going to come from. Now, implementation is different for every family, but oftentimes we might just be staggering some short-term fixed income, something that's going to have a defined outcome. So we're not worried about how that's going to react to changes in interest rates and things like that. Where do we pull that money from? Oftentimes, we're not pulling that money from dividend paying stocks. We're pulling that money from growthier parts of the market that have done well in 2026 and using that to recalibrate our portfolios.
833-964-PLAN. That's 833-964-PLAN. Go out to getretired.stayretired.com. So, David, go into a little bit more detail because, again, I mentioned the rebalancing piece, the dynamic scoring. What is it that makes VestGen Wealth Partners different with its scale that allows us to create more efficacy as compared to the typical solo advisor model who has several maybe assistants or team members?
Yeah, well, oftentimes with a solo advisor model, things are going to be on a very set calendar basis, March 30th, June 30th, et cetera, where they're rebalancing just like a 401k would, right? They have to automate it because they have limited capacity. So they're going to do it at the close of the quarter versus a more dynamic way of rebalancing that has to do with valuation. So when we hit a certain price point for a certain asset class, we hit that target. That target is what drives us to make those changes. And we don't know if that change is going to happen on July 1st or August 15th. But when we get to that price, then we execute. I think that's the difference from a firm like VestGen that has dedicated traders that their full-time job is to execute trades versus maybe an advisor who's spending time in the conference room with clients. Those trades aren't happening at a specific time because, quite frankly, the calendar doesn't allow for that to happen. But execution makes a difference when you hit a certain level of responsibility, when you're running a large portfolios for families throughout the country. We want to make sure we're squeezing out every penny, and execution is a big deal, both on the fixed income and also on the equity side of things.
Well, and I think, David, that fixed income component is really important because fixed income is another word for bonds. But I suspect it might be last call for bonds, right? I mean, we saw consternation again over the Iranian situation, which has been ongoing ever since March. But then we did see some relief later in the week in terms of oil prices, which also affects interest rates. What's your specific advice for everybody out there relative to the 40% of their money that may in fact be in bonds? I mean, right, David? A lot of portfolios have 30 to 40% in bonds, but what's your advice right now and why to everyone listening?
Yeah, I just read an article that some famous bond manager said, be prepared for higher interest rates, which would be a negative for bonds. So as I talk about in the conference room, if you're going to de-risk portfolios, be careful of what you're de-risking into, because you might be de-risking into an asset class that's extremely volatile. And what we know is you don't want to make a call on what the Federal Reserve is going to do, because there's a lot of factors that might adjust their opinion. So my preference is, in investing, there are little defined outcomes. You don't have a defined outcome on a stock, but you can choose to have a defined outcome on the fixed income in your account. So if you own something that has a maturity date, you're less concerned about what the inflation numbers look like. You're less concerned about what the Federal Reserve is doing. So as opposed to judging whether or not the Fed's going to increase or decrease rates, my suggestion is lock in the interest rates now. That removes that inflation risk from the portfolio. And then ask yourself, if we also combined inflation with perhaps a weakening dollar or a slow growing economy, should you use some non-traditional assets as a complement to your fixed income so that you have something that zigs when everything else zags? I think that's what people should be asking themselves. So maybe it's not 60-40, maybe it's 60-30-10, or whatever that allocation needs to be. I think investors deserve to learn about what other opportunities are out there today.
Well, yeah, I mean, building true multi-asset class portfolios really matter. I mean, we touched on the concept of real return in the first segment. I think, David, we also need to make sure we're talking about permanence and definition. So give a teaser, because that's such a big driver for us at VestGen. What is permanence and definition to go ahead and fix that fixed income side of the portfolio?
Yeah, it doesn't mean get rid of your bonds. It means consider changing your vehicle. And by changing your vehicle, if we purchase an individual bond and hold it to maturity, assuming no default, we know exactly how much we're going to earn on that investment, because that's our yield to worst calculation. So if I buy a bond and hold it to maturity, I know what the interest rate is, when I'm going to get my money back. That's much different than owning a bond index fund where there is no maturity date. So if I'm going to retire and I'm going to start taking monthly distributions, it could make sense to build out a staggered bond portfolio where you have money maturing every several months. So you know exactly where those distributions are going to come from for several years, as opposed to being forced just to collect the coupons from a bond mutual fund. There is a better way to do it. It just is the execution on how it happens. And firms like VestGen have better execution because they have more infrastructure to help create these customized portfolios for individual clients.
You know what, David? We got a lot of great information coming up. You know, when we come back, I want to talk about one of the arms races that's happening globally. There really are two arms races that are happening globally, and I want you to know how we're dealing with that, how we're thinking about that. In the interim, connect with us online at getretiredstayretired.com. That's getretiredstayretired.com. Download our free guide on real return investing so you too can move past.
Would you like a dose of knowledge? Good, because Craig is back and about to fill your retirement prescription. Back to In the Know Radio on AM 560. The Answer.
So everybody knows that artificial intelligence continues to dominate the investment conversations. And I think investors are asking critical questions like, who are the long-term winners? But I think part of that critical question should actually be a discussion of the geography. What countries are actually going to be the long-term winners? And then from a country standpoint, then you can start breaking down and talking about the domicile of the ingredient weights. So David, bring us into this discussion about the arms race, because you've oftentimes said there's an arms race. Now that's bombs, munitions, and of course drones come to the list. but the AI truly is an arms race as well, is it not?
Yeah, I mean, this is not a product. It's becoming the operating system for the global economy. Think about what electricity did 100 years ago, or about what the internet maybe did 20 or 25 years ago. Artificial intelligence has the potential to transform every industry, every business model, and lots of different consumer experiences. And the companies and countries that provide the computing power, the infrastructure necessary to make this stuff work, and the talent. I mean, this is going to drive, I think, that allocation of capital for several decades. So maybe we talk about that country allocation, Craig. There are 3 countries that we hear about in the media that tend to be at the top of the list in terms of that AI arms race. It's China, it's South Korea, and it's right here in the United States. Why are those big 3 countries the ones we usually hear about?
Well, David, I would like to say it's the United States, followed by China and South Korea. I appreciate you naming them, but remember, this is America, and this is AM 560. America always goes first in the list, buddy. But each of these countries that David mentioned's got a unique advantage. I'll acknowledge it in David's order. I mean, China, damn, they got just incredible scale. South Korea, we're talking about world-class manufacturing, semiconductor manufacturing, that is. And then there's the United States, though. See, we combine technology, capital formation, we're the World's Bank guys, innovation, energy, and we got demographics. Yeah, we got demographics on our side. And when you look at the complete package, America, I got news. We've been saying we've got the inside lane on AI. Listen, everybody, that's not just because we got more data centers than the next 10 countries combined. Arguably, if this is poker, I think we got the strongest hand. And that's important, not because you're trying to predict a winner in the next 90 days. You're trying to identify long-term secular trends that are going to create and grow wealth over the next decades to come.
So let's talk these countries specifically. China first. No offense. I know you want to start with the US. But a lot of people have written off foreign investing altogether. We talk all the time that it's made a resurgence starting last year. Is writing China off completely a mistake in investor portfolios?
No, I think you can't do it. You know, you might want to do it. I think you can't do it, though. I mean, China's got this enormous engineering workforce. They got manufacturing capabilities, and damn it, they're difficult to replicate. They got the ability to deploy AI across logistics, industrial, healthcare, consumer apps, all at an enormous scale. So from an adoption standpoint, yeah, China matters, but they got challenges. Let's talk about them. Number one, demographics. They're horrible in China. I mean, remember some of the birth policies that they had over there. Didn't do them any favors, right? And an aging population creates long-term economic headwinds. And that's one of the reasons why the U.S. is still in a better spot.
So let's talk South Korea then. Usually doesn't get mentioned in the same sentence as China and the United States, but what are your feelings on South Korea and why should people be aware of it?
Well, it's not just the World Cup. Check out the South Korean team, but I think it's really this. It's AI runs on chips, semiconductors, and South Korea happens to be one of the most important suppliers of memory technology in the entire planet. I mean, many of the AI systems that are being deployed today, they don't function without the semiconductor ecosystem that's domiciled in South Korea. So when you think about AI, you're not just thinking about the software companies, you're thinking about the entire vertical. Yeah, that's what I call the supply chain. Who makes the chips? Who supplies the memory? Who powers the infrastructure? And that's where South Korea becomes an interesting geographical story.
But ultimately, we bleed red, white, and blue, right? So let's get back to the US. I think the US is the strongest because I think that we drive a lot of like the idea formation. It's our ideas, right? And then we need some partners to sometimes execute. But if you had to maybe refine the US stronghold for just a couple of talking points, what are those talking points that ranks US number one in this AI arms race?
Technology, energy, demographics, technology, energy, demographics. Technology, the U.S. remains home to the world's most important AI innovators. It does. These are American companies, guys. The software, the cloud infrastructure, the advanced chip design, the venture capital, the private equity, the direct lending ecosystem, the research universities, and of course, free markets powered by free men and free women. That's an entrepreneurial culture. That's why America continues, and America does, and America will continue to lead in innovation. But David, the second one I mentioned is energy. Talk about that.
Well, every AI query requires some compute power. And we know that doing a basic Google search doesn't require as much compute power as a Chat GPT search, where you might get a more refined answer. So I think people are starting to recognize, as they see on the 10 o'clock news, that data centers are being built everywhere there's an opportunity. All of those data centers require electricity and lots of it. In fact, AI may ultimately become one of the largest drivers of electricity demand we've seen in decades. In fact, in the conference room, Craig, I love showing this chart, and shows that energy demand has basically been stagnant for the last 20 years. But if you look at the projection of where energy demand is going, it's through the roof. And I think when people see that, they start to recognize that we are in a defining moment for our economy, which also creates massive investment opportunity for investors who are just on Main Street that want to play AI in a different way.
Yeah, natural gas, power generation, utility, storage, nuclear development, the transmission mechanism of all that. It's a really big deal. So listen, AI isn't just a tech story. It's a little bit of an everything story, right? And the third thing, since we're talking about why I think the US is in such a good spot, is just the demographics. I mean, it's overlooked. I mean, I always say there's a graying of America. The baby boomers are leaving the workforce. But look at us compared to China. Look at us compared to the US. We do have a growing consumer base. We have a consumer base that demands innovation. That can come locally. And ultimately, all this economic growth, guys, we're still a consumer-driven society. 2/3, 70% of GDP is from consumer spending. We've got the consumers. We've got some of the greatest GDP per capita anywhere around the globe. And so I think it's for that reason, everybody should be leaning into the verticals that are driving artificial intelligence. People should be leaning into multiple places of geography. We just talked to you about 3. I mean, there's so much more on this topic, but I think that's a really good first start. And if you're curious, Ted Lasso's curious. I guess I want you to be curious too. 833-964-PLAN. 833-964-PLAN. Go out to our website, getretiredstayretired.com. Getretiredstayretired.com. Don't just focus on the technology exclusively while ignoring the ecosystem, because there's winners in this old economy. There's winners in all these other areas, and I think your portfolio deserves to be more than a one-trick pony. Don't just rely on technology earnings. Let's broaden into the other verticals that support exactly that. You're listening to Craig and David Bolanos in the Know Radio. VestGen Wealth Partners, AM 560, The Answer.
It's more In the Know Radio with Craig Bolanos on AM 560 The Answer, where his goal is to pummel you with financial know-how until you say uncle.
It's so critical to focus not just on what you earn, but focus on what you keep. And a big part of everything that happens at VestGen Wealth Partners is all about tax mitigation. David, you've said it well so many times. The leverage gets initiated through tax strategy, the enhancement and implementation through a robust investment program based on cash flow models, but it's tax strategy that really matters. And, I just did this with clients that are, in the United States, they're retired, although the same clients spend time in Australia. And what we talk about every single year is making sure we fill the 10 and 12% tax bracket. And when you're married filing joint, I think people don't realize that you can fill up the 10 and 12% tax bracket. Again, 12% marginal bracket up to almost $140,000 of income. David, how do we do that? And why is it so important?
Yeah, great advisory firms are always thinking 2 steps ahead. Where do we need to be in 4 years, and what are the small steps we're going to take? And I use that example when we talk about things like RMDs and how much we're going to have to take out of accounts. And to your point, if your advisor's not sitting down with a copy of your tax return and matching it up to marginal brackets and average brackets, I think we're missing the boat. So when we think about the 12% marginal bracket for a couple filing a joint tax return, on the surface, that goes up to $100,800. But you mentioned, Craig, you could put almost $140,000 on your return. So how do you get to 140? Well, you get that $100,800. You add in the standard deduction, which this year is $32,200. If you're over 65, each person would qualify for the senior bonus deduction. So now we're around 144,000 of total income you could put on your return, but still be in that 12% bracket. There's a lot of people out there that might be putting 100,000 on the return. We've got a lot of room to get access to capital, because retirement planning is taking advantage of the arbitrage. If you were a dual income household while you were working and you were in the 24% marginal bracket and you funded a pre-tax 401k, well, you got a 24% deduction on those dollars. How awesome would it be to get those dollars back at a 12% tax rate? We want to take advantage of a tax deduction at 24 versus 12% in retirement. And you might say to yourself, hey, I don't need the money. But where do you think the tax rates are going in the future? 12% is probably as good as we're ever going to get, running at a $39 trillion deficit. So we should be doing everything we can, whether it's Roth conversions or simply pulling money out of accounts to maximize that 10 and 12% bracket, because that's how you win. And I think it's as simple as that. It's, did you get a 24% deduction when you put the money in? And wouldn't you be happy to get it out at a 12% rate? That's way more important than trying to cherry pick the best tech stock to own. You probably just need to own both of those stocks and then win on the taxes, because that's a repeatable process that we can do every year. You just got to do the homework.
Yeah, do the homework. I think that's the message. Do the homework. And David, take a look. You had gone ahead and, sent me some great articles and things on a Sunday morning. They're in my inbox. And, people here, pay some taxes now, and they immediately think that's a bad idea. But you really hit that there's leverage. You got a 24% deduction while you were working. You're taking the money out at 12. That's tax arbitrage. That's like a guaranteed 12% rate of return. I don't know how people aren't focusing on controlling what they're controlling. But David, so many advisors aren't taking the time to do that. So many advisors are missing what I call the tax window. Dave, can you talk a little bit about what the tax window is and how people work through that?
I call it the retirement sweet spot. Often there's a period in retirement and your required minimum distributions where your income is temporarily lower. That's when retirees may have tremendous control over their tax situation. Every year they can ask, how much additional income can I recognize before I move into a significantly higher tax bracket? Then they can use Roth conversions or maybe just simply IRA withdrawals to intentionally fill those brackets. So we can control this, right? Perhaps you retire January 1st of 2027. You have no wages on your tax return. You probably have interest income from your bank accounts. You might have capital gains. Well, that's pretty easy to forecast. So your income's pretty darn low that year. We remove those two incomes and then we subtract that from the bracket. And that's how we determine how much we could withdraw from these accounts every year. It's just doing the homework, but it's not complicated math. It's just drawing the lines in the sand of here's what we don't want to trip over. And then we execute.
Yeah, and that's why Roth IRAs, that's why taking withdrawals to fill up those first two brackets, either way, are so incredibly important because there's all these stealth taxes, David. What's an example of a stealth tax that just drives you bonkers?
IRMA is probably the one that hurts most people. Might not hurt them significantly financially, but it hurts their feelings. And here's why. Once your taxable income exceeds a certain amount, now they reserve the right to charge you more for your Medicare. So you and your neighbor might have different Medicare premiums, even though you have the exact same insurance. And the challenge with IRMA is it's cliff vested. Cliff vested means if you're $1 over the limit, now you have to pay the surcharge for 12 months, where other things, it's just progressive, meaning you're $1 over the limit, only that $1 taxed at a higher rate. No one likes IRMA because no one likes paying more for the exact same benefit that people pay less for.
Yeah, and I think all of this, if you're just tuning in, is about tax strategy. The leverage comes with strategy. Don't focus on investing first. Focus on the taxes. Focus on the cash flow. Then start backfilling with the investments. That's where the leverage comes from, because it's not just the stealth tax, David. It's not just future proofing. It's also surviving spouse risk. What are we talking about and why is it so important? And more people should plan for that. We do plan for surviving spouse risk at VestGen Wealth Partners because we see it every day and it deserves to be spoken and then mitigated against.
Yeah, something like IRMA is a great example, right? Well, IRMA doesn't kick in until you get to that 24% bracket if we just want to use simple numbers. But once we're a single filer, we cut that in half. So we call that the widow's tax trap. We've seen situations where a couple thought they were managing taxes effectively, only to discover that when the surviving spouse is doing their tax return, that they have significantly higher tax rates. Now, sometimes, Craig, let's be honest, there might be so much capital that you can't do anything about it. But part of planning, I think, is creating clarity and helping folks recognizing what could change in the future so they can digest that and kind of get their arms around it. If they want to take more aggressive action now, then certainly we can help implement that.
Well, yeah, David, it drives me nuts. How many surviving spouses have we seen move from a 12% marginal bracket when they're filing joint to 22% single the next year after the death of a spouse? How many people married filing joint are at 24% and then the surviving spouse the next year ends up 32? That's 8 to 10 percentage points of tax drag. That's like saying the first 8 to 10% you're going to make on your money just goes away to the IRS. So here's the bottom line, everybody. The most successful retirees aren't simply getting good investment advice. They're getting good investment advice paired with tax advice. And that's what we're offering. We're offering you end-to-end holistic advice so you too can start thriving, not just surviving in retirement. So you too can worry less, which allows you to live more, so that you too can fulfill the ultimate promise, which isn't just, yeah, we got retired, but we stayed retired. So connect with myself, connect with David online. Get Retired, StayRetired.com. That's Get Retired, StayRetired.com. More to come. Craig and David Bolanos in the Know Radio, AM 560, The Answer.
Okay, Windy City, get ready to be blown away with a hefty gust of financial know-how. You're listening to In the Know Radio with Craig Bolanos on AM 560. The Answer. 833-964-PLAN or go to our website, GetRetiredStayRetired.com. You know, they often say complacency is the enemy of success. And I want everybody to think out there, with the market trading at all-time highs, what action items are you going to put on your calendar for the remainder of summer? Well, in our first block today, we talked about a handful that I think are extremely important. Number one, refill your reserves.
why not take profits into a strong bull market when prices are high, so that if the markets falter in the second half of the year, you don't have to scramble to find that cash flow. Number two, when times are good, work on the boring stuff. Update that estate plan. Go through and do a beneficiary review to make sure you dot the I's and cross the T's. And let's do some tax planning as we go into year end. Use the new senior bonus deduction to your benefit. Have you looked and seen what your effective tax rate is, not your marginal? Because there's a huge difference between being in a 12% rate versus a 22%. And unbeknownst to a lot of retirees, a lot of people still have a little bit of room in that 12%. So let's see if we can max out that 12% bracket, accelerating distributions, or perhaps we do some aggressive Roth conversions while we can over the next 3 years. So if you find yourself struggling to fill up your checklist, then give us a call, 833-964-PLAN, or go to our website, getretiredstayretired.com. Because if you heard us talking about some of these things and they're starting to resonate, which is you fix the roof when the sun is shining, or real return investing, how retirees stay ahead of the inflation game, then go to our website, download the guide, or better yet, ping us with an email, give us a call, and sit down and just have a conversation. You'll want to understand what our value system is. Likewise, we're going to want to understand what's important about money to you at this juncture in your life. And if we have a great conversation, then we can dive into the details and start working together to get your family from a place that's okay or good to optimal, however you choose to define that. It's a privilege for us to have these conversations each Sunday, and we look forward to continuing it next week. 833-964-PLAN. You're listening to Craig and David Bolanos of VestGen Wealth Partners on your favorite station, AM 560, The Answer.